Uh, Hello everybody, my name is Adam Narczewski, I'm Deputy Regional at XTB. And let me welcome everybody to this series of webinars, but at the beginning let me just tell you a little bit about some organizational rules that we're going to have. The webinar will be held in English because this is the mother tongue of our guest, so please be prepared for that. Also, if you have any questions for our guest, please write them down in the chat window. We will be writing those down, and we will have a Q&A session at the end of the presentation. So, with no further delay, again, let me welcome everybody to this special series of webinars with our special guest. Why so special? Well, every trader, investor, whoever made a trade with real money on a real account knows that psychology is not one of the, but it is the most important aspect in trading. And our expert, knows about this a lot. You can write books and you can talk for hours about trading psychology, and actually our guest does both. His experience goes for teaching and coaching not only athletes, high-profile athletes, but also traders, fund managers from investment banks and hedge funds. He is a trader himself, so he knows what we all here deal with on a daily basis. He is also the author of the best-selling book, High Performance Trading. So if you haven't read this one, please do. So without further delay, please let me welcome our special guest, Mr. Steve Ward.
Thank you, Adam, and welcome everybody. Thanks for joining us for this webinar. Adam's done a really good job of my introduction there. I'm just going to see if I can get this, but I'll just give you a little bit more information. So I've been involved in working in trading psychology now for just over 10 years, nearly 11 years now, working with, as Adam said, traders and fund managers from investment banks, from hedge funds, investment funds, energy companies, proprietary trading groups, as well as with retail traders, people probably like yourselves who are trading from home, with experiences in terms of being new to trading all the way through to people who've been trading for 20, 25 years or more. And my expertise, as Adam has said, is around the performance side of trading, around the psychological side of trading. So I'm really trying to help traders and investors to improve their decision making, to improve their performance, to help them to deal with the emotions and the stresses and the pressure of trading and investing, to kind of manage their mind more effectively, to develop good trading habits and discipline. And I do that through a variety of ways, through both coaching one-to-one as well as training. And actually, I've actually done quite a significant amount of work actually in Poland. So not enough to be able to conduct a webinar in Polish, I'm afraid, but I've certainly been over to Poland many, many times over the last 4 years. So it's great to be able to do a presentation for you guys. As I said, I've done initially quite a lot of work in sports psychology. That was my initial background. I've done some work with professional poker players on the European Poker Tour, a little bit of work involved with the military. But I say my main focus really for the last 10 years has been in trading and investing. We've got 3 webinars lined up for you in this series around trading psychology. So today we'll focus on, I guess, the core parts of trading psychology. When we meet again in January, we'll have a look more around mindset and how our thinking affects our trading decisions. And then in February, we'll have a look at the very important role that emotions play in our trading and our decision making. So today I want to really just help you to understand a bit more about the role of psychology in trading, how it affects your trading behavior, and just begin to give you a few things to go away with that can start to help you to be more effective in your trading decision making and performance. essentially, I think, a lot of trading education, and you've probably been to many yourself, it kind of revolves around, it's focused on trying to give people, the winning trading strategy. And actually, the winning trading strategy is relatively straightforward. Buy low, sell high, or obviously vice versa. And, we all know, I guess conceptually, we know, how to make money in trading. And actually, even when you write down, somebody's trading strategy very successfully, it looks relatively straightforward on paper. But as we all know, those of us who have traded live, the challenge in trading is actually not so much just having that plan. It's not so much as having the strategy. It's, are we able to execute the strategy in real time, in the uncertain environment of the market? And I just want to kind of help us to kind of dig into this a little bit more, this idea around, essentially, we need to run our profits, cut our losses. The core concepts are there. We know the reality is very different. And let's have a little think about why that could be. So here's just a question to be thinking about. So imagine that you've just been given $1,000. We'll work in US dollars for now. And then you're given a choice of keeping the $1,000, or you can take some risk. Now, the risk that you can take is to toss a coin. It's a fair coin. And if the coin lands on heads, then you double your money, you win $2,000. But if it lands on tails, then you lose. So the choice here really is, do you keep the $1,000, or would you take the risk, losing the $1,000 but potentially winning the $2,000? So just have a think about what you would do, and maybe just make a note of your answer. And now let's look at a slightly different scenario. So in this example here, it's a little bit different. So this time, imagine that you have to pay me $1,000. So you pay me 1,000 US, or again, you can take a risk. We're going to throw the coin again, toss the coin again. If it lands on heads, you lose nothing. So you pay me nothing. But if it lands on tails, then you have to pay me $2,000. So the choice here is you can just pay me the $1,000, or you can take some risk, and then we can throw the coin, or you can throw the coin, and if you're correct, if it's heads, you owe me nothing, but if it's tails, you pay me $2,000. Again, I'm just curious, have a think about what would you do? Imagine if the money was there, if you actually had that money and you had to hand it over to me, and then you had that choice, what would you do? Now, this is an interesting question, because if we look at the first example, you were given $1,000 and you were asked, would you take some more risk or not? Now, most people in that example, and it's 84% of people, will take the $1,000. Okay? Now, what this shows in terms of a behavior is risk aversion in a situation of gain. So when people are in a situation of having made some money, people show a strong tendency towards risk aversion. Excuse me. Now, that's interesting. So if you put that into trading terms, what it means is that it's going to be harder for people to run their profits, because as they start to make profit, as they get into more and more gain, they might become more risk averse. So we're seeing here a tendency, 84% of people, a tendency here to actually cut profits. Let's look at the second example. Here, what we're seeing is, in a situation of potential loss, you could lose $1,000. We're seeing here that now people are much more willing to take risk. So we see people being more willing to take risk in a situation of loss. And this, of course, in trading terms, shows us that a strong number of people, and here it is 70%, is the study sample, are willing to take risk to avoid that loss. And this is where we see people more willing to run losses. So there's a tendency within us to take profits early and to run our losses. And as we know, that alone goes exactly against what we just saw about in our winning strategy around running profits and cutting losses. So if we start to look at what does it take to be a successful trader, if we look at actually what it takes to be successful in any area, there are some very common things around them. Now, I think the really key thing, having worked in trading and investing for the last almost 11 years, is that I see or have seen thousands of different traders and investors, and there are some commonalities, some things in common for sure, but there are also lots and lots and lots of differences. You know, if you pick two highly successful traders, they can be very, very, very different. But there's some core things that are important in terms of what it takes to be successful overall. And these are the three things which are critical for you to be working on. So to be successful in trading, you do need to have skills and knowledge. You need to kind of know what you're doing. That's important in terms of competence, which actually underpins confidence. So you need to know what you're doing. You need to have the key skills. And we'll look at this in more detail in a moment. You need to have a strategy or strategies. You need some way of being able to implement, to put those skills and knowledge into practice in the market. You need some way of trading and investing. You need a method. But just as we see in sport and we see in the military and we see in trading, having the skills and knowledge, having the strategy alone isn't enough. It will only get you so far. It's really the beginning, because once you're involved in the market, so when you're taking a high pressure penalty or you're in the combat zone, then your physical, your mental, your emotional state has a big impact on your ability to be able to use your skills and knowledge to be able to actually execute your strategy effectively. You know, if you're stressed, if you're high in stress, or you're worried, or there's strong levels of fear, it impacts your ability to think clearly, it impacts your ability to be disciplined. So you could have the skill, you could have the strategy, but the fear gets in the way. Likewise, fatigue, if you get very tired, that can affect your ability to think, to access your skills and knowledge, likewise to execute your strategy in a disciplined way. Where you're focused, again, if we look at it from a mental perspective, or how you're thinking, again, so, the state factor is really the psychological side of trading. Of course, it's not good enough just to have the third factor. Having the state alone isn't enough. You need the skills and knowledge, you need the strategy. But once you've got those two, or once you're developing those, then that third S, the state, becomes a very important part of your trading. And that's what we're going to have a look at really over these 3 webinars, is factors in this state area here become really critical. Let's just briefly, literally very briefly though, just think about skills and knowledge. I'm not going to go through these, but for you guys, it is important to recognize, to be successful in any area, whether it's trading, whether it's investing, whether it's music or the arts, or whether it's sport or poker, you need to have the skills and knowledge. So it's really critical. If you don't have the knowledge and skills, then when you're trading, you will always have a high level of anxiety and worry. Your confidence will be lower. And it's not a psychological issue. It's just the fact that you don't have the competence in what you're doing. So it's really important to work as hard as you can at developing the skills and knowledge that are required to be successful at trading, because that automatically improves your confidence, reduces anxiety and worry. So, that's something obviously not important, that we're going to cover in these sessions, but it's something you guys need to be really aware of, is having that skills and knowledge, having the competence. You also need to be working on, and I'm guessing you've probably done quite a lot of work on this, but you also need to be working on strategy. You need that second S. And the key here is to get the right mix. It's a bit like a recipe, I guess, of you, the trader, of the markets you trade, and then the strategies that you use to trade those markets. And for each of you, there's going to be a different combination. This is why there's no one particular winning trading strategy, because each of you is different. So, as traders, you need to find your own way of trading. And actually what's really important here, if you're a newer trader, is spending some time experimenting. When we look at the psychology of learning to trade, and I do quite a lot of work with newer traders at banks particularly, and in prop trading groups is, we've got to try and help you to find the right formula for yourself. That if there is a holy grail, it's not the holy grail of a particular strategy, it's your own unique combination, or trying to find as close as you can. And to do that, you need to experiment. Some of you may only have traded one particular asset class or one particular type of strategy. You might have learnt your strategy from somebody else who may be like you, but who may be quite different to you. So it's really important to, in the early stages of trading, to experiment, to try things out, to evaluate what's happening, so that you can get a feel for, the markets that you tend to be, or you enjoy trading, that you're successful at trading, the strategies that work best for you, the ones that seem to fit you the best, the time frame, short time frame versus long time frame, the amount of risk that you like to take, and so on. And that's a really key, is developing that strategy. And again, it's not something obviously it's going to be core to the 3 sessions we've got together, but it is important because the skills, the knowledge, and the strategy, if you've got those in place, then trading psychologically becomes a lot easier. If you're lacking the skill and knowledge, and you don't have the trust or belief, or your strategy is not maybe the correct one for you, then that will create psychological interference for sure, but it's not a psychological challenge. The challenge is a skill and knowledge or a strategy challenge. And when I'm coaching traders, that's one of the things I have to look at when I'm working with them is, what's the challenge? Is this really a psychological challenge, or is the challenge actually a skill challenge or a strategy challenge? So they're things to be working on for yourselves. Of course, the markets are dynamic. So once you've found your niche, once you've found your sweet spot, of course, it won't stay the same forever. The market's dynamic, the markets change. And what you have to be as a good trader is you have to have a kind of, I guess, a creative, a problem-solving type mindset. As the markets change, you're looking to, either change your strategy or change your approach as a trader to best meet those new conditions. So there's an evolutionary process to being successful in trading over time. Now, our third S is obviously our main focus, is state. Mental, emotional, physical. Essentially, we're talking here about the psychological side of trading. It's interesting if we look at this results here from a study that I conducted with some of my clients in 2014, I think this was. So we asked, what's the main factor that's stopping you from maximizing your market returns? What's the interference? What's getting in the way? And we can see very clearly by a long way, it was themselves. It's mindset, it was beliefs, it was perceptions, it was emotions. It's that state factor. And the thing with trading is that, essentially at the crux of it, and I think Warren Buffett said, it's simple but not easy. It is relatively simplistic in terms of the key ideas, but it's very difficult in terms of actually being able to carry out those ideas in the market environment. And that's because we've got a very interesting cocktail, really, of factors in the trading environment. So, we've got uncertainty, which creates stress for the brain. Humans prefer certainty. Uncertainty is more stressful for us. We've got, obviously, we're taking risk. So there are consequences to those actions in that uncertain environment. We've got stress coming through in the nervous system. Many of you will probably be trading quite short time frames. That, again, increases the stress factor. And of course, we're very conscious of, we're doing this to achieve results. So there's extra pressure and stress coming from there. And all of these factors combined create a very difficult environment for the brain to make our trading decisions in. So what we've got to try and do is work out, what can we do about that? And that's where, the psychological skills become so important. Just having the skills and knowledge, just having the strategy alone won't help you to deal with all these other factors. Now, if we look at the impact on your trading behavior, it's quite interesting. So what I've done here on this slide is just really list a few of the types of behaviors that we might see from traders, which reduce their market returns. So we'll quickly read through the list, and maybe for yourself, be thinking about which of these you do. So you might think maybe I do this, regularly. So it might be something you do often. It might be something you do maybe just every now and again. It may be something that you do, never at all. So we can do it as a kind of a quick self-assessment. So, one thing we see as a result of the psychological side of trading is traders, cutting their winning trade short even when they've got a good setup. Not pulling the trigger on a good setup due to fear of loss. Letting losing trades run in the hope of getting back to break even. Adding to losing positions, hoping the market's going to turn around. People, quite a common thing we see, people make money in the morning, but then they give it back in the afternoon or back in the next trading session, becoming more aggressive after losing money. Taking unplanned trades, when the market's suddenly moved. So, you sit in front of the screen, the market's moved, maybe some volatility kicks in. It's not really a trade according to your strategy, but we get tempted to dive in anyway. Stopping trading or reducing size after a loss. Trading bigger positions than you would normally take, maybe, getting a bit overconfident. Holding trades too long, trying to max out a trade looking for the big winner. Not taking trades because our last couple of trades maybe were losers. After a series of winning trades, confidence rising, overconfidence coming in, taking more risk, maybe decision-making suffering. Or, for some traders, getting very good at making small money, but never being able to kind of really step up and get to that next level of success. And these are certainly all types of behaviors that I've seen regularly. And I see these behaviors not just in beginner traders, but also in some very experienced traders, maybe not as frequently or not as intensely. But the one thing we all share is we're all human. And the one thing we know is that the human brain, as we touched on very briefly, and the trading environment, there's some challenges when those two things come together. It's why we have to learn to think differently to be successful as a trader. If we just keep the normal human brain in the trading environment, we won't maximize our returns. So what I want to try and do over the next 3 sessions, today and the next 2, is start to think about how we can reduce the amount of interference, or the amount of impact that your thoughts, emotions, your feelings and your behavior have on your trading. I want you to be able to get as close as you can to the returns that your strategy should be bringing for you. Now, we won't be able to guarantee that, certainly in 3 webinars. It's a very short period of time, but hopefully, we can give you a few things to get started. Then also you can go away and do some of your own reading as well, add into that. But essentially, if you think about it, this is a model to work to. Think about a funnel, as you can see on the screen. And what we want to try and do as traders is we want to maximize our edge. We want to maximize the potential. We want to make sure that when we're going into the trading session, the chances of being successful are as high as they possibly can be. And that means, we have to, again, we need the skills and knowledge, we need the strategy, we also need to look after our state. The bigger our edge becomes, the smaller the amount of interference. This is what's really key. This is why it's important to build good trading habits, to build a good trading process, to build good trading practices, and then to consistently stick to them and adapt them and evolve them over time. So, sometimes people come to me for coaching with a whole variety of trading issues, and we're trying to manage, or they're trying to manage those issues. The goal really, if we can, is we want prevention. Let's be doing the right things up front so we can prevent, and reduce the amount of interference, and then we just manage whatever's left over. Now, as a framework for doing that, these are the 3 key factors to really think about when you build your trading process. In all high performance areas, process is really, it's the bedrock of performance. So, having a good trading process is critical to achieving trading success. And your process can, essentially can have 3 key chunks to it: planning and preparation, execution and evaluation. And in the middle of that, really, I guess, I've put mindset, but really it's mindset, it's self-management, it's the you factor, which holds everything else together. Now, planning and preparation, that's, at the start of the trading session and over time, is what allows you really then to go in with some ideas, know what to look for in the market. The execution phase is the trading itself, evaluation is then obviously assessing and analysing what actually happened. And that cycle is really important. And what I tend to find is people are generally okay at planning and preparation. People obviously really enjoy the execution side of trading. That's where they tend to mainly focus. People are generally not quite as strong on the evaluation side. But if you want to be a high-performing trader, if you want to, give yourself the best chance of being successful, then you need to commit to, building a process that has all those three elements in it, as well as working on yourself, your mindset as well. Now, in today's session, we're going to focus around planning, execution, and evaluation, and a few things to do at each of those levels. And then in sessions 2 and 3, we'll dig a bit deeper into mindset, and we'll dig a bit deeper into emotions. But I'll give you a few other things to be thinking about as we go through today as well. So when we think about preparation, and I remember working with a very successful trader, and he said to me that his belief is that on any given trading day, probably only 30% of traders are properly prepared for the markets. And he felt that gave him a real edge over the 70% that weren't fully prepared. When we're prepared, we feel a bit more in control, we feel more confident, we feel less anxious. It gives you, a good starting point for the trading session. Now, your preparation should have 2 parts to it. The first part is your technical and your tactical preparation. So things such as, looking at overnight news, looking at data that might come out, any relevant fundamentals, maybe looking at, some technical levels, support, resistance, and so on, whatever might be relevant to your strategy. And then tactical really is like the game plan, how you're going to trade that session. So, what's coming out, where the opportunities might be, how you identify them, and so on. The second part of preparation is then the mental, emotional, and physical preparation. Is you being ready. And this involves things such as, having slept well, making sure you've had, if it's in the morning session, having had breakfast. If you're trading later in the day, again, that you've had something to eat. The brain sits inside the body. It takes its fuel from the body. If you're tired, if you're fatigued, the brain can't work optimally. You'll be more prone to decision biases. You'll make more mistakes. So we want to make sure the brain is fueled up, and it needs glucose, it needs oxygen, it needs rest. Some traders, certainly some of my clients, we would do either something like a relaxation technique or some meditation or a mindfulness type technique before we start the trading session. Could be as short as 60 seconds, maybe 3 to 5 minutes. We would also maybe look at doing things such as mental rehearsal, so imagining the trading session coming up, thinking about particular scenarios that might happen, and then what we would call if-then. So if this happens, and if data comes out, if it's non-farm payrolls day, if non-farms comes out as expected, what would I do? If it comes out below, what would I do? If it comes out above, what would I do? So we're doing like some rehearsal in the mind, and that's actually a very powerful strategy, because what you're doing essentially is you're taking away some of the uncertainty by looking at what things are possibly could happen and working out your strategies that you would do. And in the moment, if they do happen, what you'll find is you'll get a much lower stress response. So preparation, if you think about in sport, if we look at the military, preparation is critical to success, and it is so in trading, and it's a performance habit. Preparation, we need to build the habit, and you need to be as well prepared if you can. If you're entering the market underprepared, then you're naturally going to have a higher level of anxiety and worry and stress, and that's going to be working against you, possibly outside conscious awareness, but it's making it harder. So, it's really important to establish that good preparation routine. In the high performance trading book, this is really the whole first section of the book is around how we can get ourselves planned and prepared, so you can find out more strategies in there as well. The next part of the cycle is then execution. Now, this is when the psychology becomes very, very, very important. And what we're trying to do, the question really for most of you is, if you've got a trading strategy, is how much of that strategy are you actually returning from the market? How much money are you leaving on the table? How much excessive losses are you taking? And what we're trying to do essentially, I guess this is a key role for me in trading psychology, is we're trying to close the gap between your strategy and the execution of that strategy. Essentially, I guess what we might call discipline. And there are 5 really big factors that impact on how far that gap is apart or how close together that gap is. And the first one is your level of stress. How much stress is in your nervous system? Now, as we get stressed, and stress can come from 2 forms. It can come from fear, or it can come from excitement. So we can have kind of fear-based stress. We're worried about losing. We can have excitement-based stress when we're thinking about winning, or we are winning, or in that moment of realizing some gains. And when we're in high levels of stress, the challenge is that blood flow comes away from your thinking brain, from the frontal lobes, and goes to the midbrain and other parts of the brain required for the survival response. So we don't want to have no stress, but we don't want to have too much stress. And there are really 3 key things that can help you to manage your stress in trading. The first one, these all begin with a P, we've touched on it already, is preparation. So if you're well prepared, then that will reduce your trading stress. This is why preparation is so important. The second P is position sizing. So, the risk that you take. I see all too often traders come to me because they're having lots of stress from their trading, or lots of fear, lots of anxiety, lots of worry. And in a large number of those cases, simply by getting them to trade slightly smaller, reducing their sizing, then we can reduce their levels of stress. Often when traders increase their position size, if then they suddenly start taking their profits too quickly, or they start trying to avoid taking losses, it's often a sign that the position size is too big. So think about your own trading, and if you're having lots of challenges with your trading behaviors and your habits around profit taking and loss taking, then just try trading slightly smaller and see what happens. I literally had a conversation with a coaching client yesterday. He's been going through a tough patch in his trading. Because of that, he's reduced his size. And then when we were speaking yesterday, what he said to me was, do you know what, Steve, it's really interesting because I'm actually making really good decisions and I'm trading really well, even though I've had this quite tough period. And the reason is he's reduced his size, he's less worried, less anxious about the losses, much more able to let the profits run, and it's completely changed his trading behavior. So preparation is important, position sizing important. The third one, we'll touch on more in a moment, is process focus. Being really focused on the process of making good trading decisions, not getting too obsessed with the money you're making or losing, but we'll cover that again in a few moments' time. The second one is being able to manage emotions. Now, there's a few things we know, and we'll cover more of this in session 3, webinar 3, but emotions, and this is what we know from neuroscience, are key to how we make decisions. Emotions are actually a bit like data. They're giving us information about the world around us, and they're also mobilizing energy so we can act on that. And actually, we don't want to, often people, they want to be without emotion. Steve, can you help me to trade without emotion? It's a very common question. No, I can't. And actually, we don't want to be without it. What we want to be able to do is to work with our emotions more effectively. Now, I say we'll cover this much more in webinar 3, but the basic skill, which is really important around emotions, the basic skill is awareness, so being able to recognize your emotions, and as emotions arise, being able to name them. It's called affect labeling, naming the emotions. When you recognize an emotion, let's say it's fear, and then you are able to label that emotion, so I'm feeling some fear right now. In the brain, the emotional part of the brain, the limbic system, quietens down. When we try and resist or suppress or get rid of an emotion, that part of the brain actually shows greater activity. So it's a bit counterintuitive. So the first skill to really get good at around emotional management is starting to have an awareness, noticing your emotions as you have them, and then just naming them as they arise. Here's some stress, here's fear, here's anxiety. And work with that, and you'll be surprised at what might happen for you. Now, the other thing I say about emotions, this is more of a mindset factor, is if we see emotions as unhelpful, every time you notice one, you'll get an unhelpful response. If you see emotions as being beneficial, as data, they're telling you something, then actually you'll completely change your emotional reactivity. So, if we think about fear, why would we feel fear? Well, we feel fear because it's our brain's way of telling us very quickly that it's detected, it's sensed some potential threat. And it does that by mobilizing the emotion of fear and the energy to act on it should we need to. How would we know if there was an opportunity? Well, we'd get the emotion of excitement, which again would let us know there's a potential opportunity, and would mobilize energy so we can act on that. So, emotions are there. So, think about emotions as data, a bit like a ticker tape of information that can be helping you. And, if you change your perception of emotions, and this is something we'll talk about much more in session 3, you'll really be surprised about how their impact becomes much, much less. But it's not about getting rid of emotion, it is about working more with them. The third factor is we need to be able to manage our thinking. And again, we'll cover this more in session 2, but just really being aware of our thoughts and where those thoughts are coming from. And again, having that choice of do I act on my thinking or not, recognizing that when we're in a losing position or a winning position where stress is higher, our thinking will change. We can't always trust it quite as much. But just being able to be, have that, again, thought awareness, being able to manage our thinking, and also, our beliefs and our perceptions about the market and ourselves, at a higher level are really, really important. So again, we'll look at that more in session 2. Attention is probably a fundamental mental skill in high performance. Wherever your attention goes is where your energy flows. So, your attention's a bit like the target. So if you're focused on your P&L, how much money you're making or losing, that's where the energy's going, that's where the energy's flowing into, and you'll probably notice significantly strong emotional reactions. Where we want our attention to be in trading, for most of the time, is on our trading process. Developing a trading process is really important. How you identify opportunities, how you enter the market, how you manage positions, how you exit positions. All these stages are important, and that's all part of your trading process within the execution phase, essentially. So you need to know that process, and during the trading phase, you want to be focused on that. The goal really is to focus on making good trades. I think that's the fundamental shift, a mindset shift, is focus on making good trades. A good trade might be a winning trade, a good trade might be a losing trade, but you want to be making good trades, high quality trading. The decision making is what's really important. And I remember working with a trader who would focus on his results so much that he actually got an eye twitch, a twitch just under the eye, like a muscular twitch, which came through stress. And when we helped that trader to focus much more on his decision making and on being more process focused with no other intervention, that eye twitch went after a period of days and never returned. So, once we start to get too stressed, things shift in our system, and one way that we can induce lots of stress is by spending too much focus on our P&L, on our profits and loss, and our winning and our losing. If we can step back a little bit and get more process focused, then that can be a really, really big shift. Things that we can control, if we feel too much out of control, it increases our stress levels. So, what can we control? We can control the markets we trade, we can control entries to a degree, our trade management and our exits, not always completely, but we can get some relatively good control over those areas, but that's where we want to be focused on. And then the final factor is energy, which we've touched on briefly when we talked about preparation. But there's a great study done in Israel looking at the decision making of parole boards, the people deciding, do we let the prisoner out early from their sentence or do we keep them in? And in that study, the most significant factor that affected parole board decision making was actually energy. It was glucose and it was rest. So if you were a prisoner and you came early in the morning, you had a very good chance of being paroled. But if you came before the morning break, suddenly it went down significantly. About 20% chance of being paroled, 70% first thing in the morning. If you came before lunch, 10% chance of being paroled. But if you came after lunch, 65%. So, the amount of energy in the system is critical. So we have to be aware that the brain is sitting inside the body. For your brain to work around attention, around decision making, around self-control, around willpower, all these high level kind of thinking and cognitive functions require fuel to operate effectively. and they get that through energy, and they get that energy in the brain through the body. So, being aware of your levels of fatigue are important. If you're really tired, then that will affect your decision making, whether you are aware of it or not. And actually, if we put some of these things together, if you put stress and energy together, if stress is high and energy is low, then that spread is very dangerous for a trader. Because now you've got high levels of stress, energy is low, so now you haven't got the energy to manage the stress. What we really want is obviously, moderate stress, high levels of energy. So, these things all become very important in terms of the execution of your strategy. Discipline really is a function of having a strategy, a clear strategy, and then the execution of that is down primarily to these 5 key factors here. And I say we'll spend more time on thinking and more time on emotion in sessions 2 and 3. The third stage in the performance cycle, is evaluation. This is often the part of the cycle which I find is done the least well, or has the least time spent on it. It's very, very important. Capturing trading data, the markets you've traded, the positions you traded, what happened in those positions, data around your thinking, around your feeling, really helps you. People will tell me, but Steve, I can remember my trades. Memory is generally very, very poor. We don't want to trust our memory. We're very lucky with trading that it's relatively easy nowadays to capture data. We've got access to spreadsheets. Sometimes on front-end trading platforms, we'll obviously have access to seeing our trading metrics. We can, excuse me, we can press a button, take a screenshot. We can annotate the screenshot in real time, which I think is an excellent strategy. As you enter the market, screenshot, annotate why you've got in, key decisions along the way, screenshot, annotate it, end of trade. When you get out of the trade, exit, screenshot, and then we can annotate it. So you're getting a real-time running commentary of your thinking and feeling what's going on. Now, I think in terms of evaluation, probably a trade log of some sort is an essential. Then I think we should really be doing probably some kind of journaling process around our thinking and feeling about our trading. Some sort of periodic review. It could be daily, it could be weekly, it could be monthly. But I think there's 4 really important questions that if you want to get better at your trading, you need to be asking yourself relatively frequently. The first one, this could be at the end of a trading day, could be the end of a trading week, even a month. It depends on what time frames you're trading over and how many trades you're making. But what were my trading strong points, and why were they strengths? What have I done well? It's very easy for most of us to identify our weaknesses, what we haven't done well. That's negativity bias. We have that within the human mindset. It's a survival-based mechanism. But we also want to, as high performers, notice when it's going well, why is it going well? Which of my trades are working? So you can do more of them. And this is, again, this is something that most people wouldn't do. But to be a high-performing trader, you have to think differently. You have to do things differently to other people. If you do what everyone else is doing, bearing in mind, let's say the stats are whatever, somewhere between 80% and 95% of traders, are not profitable. So let's assume somewhere in that range that's true. Most people won't be doing these sorts of processes. In lots of areas, being average is good enough. Unfortunately, in trading, if you're average, it's not good enough. You've got to be a good performer to even be in with a chance of making any money. So, average in trading is really, is failing. You've got to be above that. So, really think about what's going well, when it's going well. Of course, we also want to notice what your limitations were, why were the limitations, this is your losses, your failures, and so on, so you can work on or around those points as well. The reason why we do number 1 and number 2 is we're looking to get some kind of learning. Learning about yourself, about you as a trader, about the markets, about your trading style, your approach, your strategy. We're looking to get that knowledge and information so that we can improve. Trading, getting better at trading is about getting better at getting better. It's about learning. It's very much a learning process. There's creativity, there's change, it's dynamic, it's learning focused if you want to be successful over time. And our fourth factor really is, what steps can you take? So you look at your strengths, look at your limitations, look at what you've learned, and that should give you some ideas for action to go away and do, which then obviously takes you a step forward to being a better trader. That's really important. So just a very quick summary of some key things, just from this kind of introductory session today, thinking about trading performance, probably the essentials, I guess. We need to remember that trading is a performance activity. It's not the same as sport. It's not the same as chess and so on. It's not the same as poker, but it has lots of similarities. And one is it's a results-driven based environment. It's measurable. There is some pressure and stress. So we should treat it like a performance activity. We should think of ourselves as performers. And if we look at in performance activities, then we know that the 3 S's become important. You need to have skills and knowledge. You need to have the strategy. You need to work hard at those 2, but you also need to work hard at the 3rd S, state, physical, mental, emotional. Working on yourself as much as you're working on the markets. State's the critical factor, particularly once you get more experienced. It's probably the most significant factor. And to help you to be as successful as possible, when you enter the markets for the next trading session, you want to have as much edge as you can. You want to have the best chance of success possible. You want a really good, big, positive performance funnel. So you've got to start building the habits of good discipline. You need to build a complete trading process which enables you to be successful. And that process has to have, preparation, has to have, solid execution, and it needs evaluation. They're the 3 key factors. So just for a moment or two, just think back on a few of the key things we've spoken about. Think about, what action could you go away and take from today? Maybe it's being a bit more focused in your preparation. Maybe it's thinking about some of those elements around execution. Maybe it's thinking about evaluation. When I wrote the high performance trading book, I was trying to think about, how do I structure it? And I used the performance cycle as the structure for the book. So the first section of the book looks around kind of preparation. The second part of the book talks around, execution factors. And the third part of the book is around evaluation factors. So, I think it's a really key model. I think it's a good model to work to. And, and again, it is about building habits. It's about being consistent in your practices, making your process really a series of, of the things that work for you, learning, evolving the process over time. But keeping that at the core of your trading is also really important. And I think, Adam, if there's any questions, now is probably a good time to take some questions.
Yes. Okay, Steve. Thank you very much for this presentation. You made us think a lot about ourselves, but there are still a couple of questions. I will be putting them in my own words, if you don't mind, not reading them directly. Okay, here goes the first one. Since most of us are rather inexperienced traders, but we do have a certain trading strategy. We know about the psychological aspects, positive state of mind. Is there a way, and there's something goes wrong, we start losing money. Is there a way of kind of finding out what is going wrong? Is it the strategy part or the psychological aspects are taking over us?
Okay, so it's a really good question. It's an interesting one. For newer traders, this is my general rule would be: the newer you are to trading, probably the more likely it is something to do with your trading strategy or your skills or knowledge or understanding of the markets. Once you start to develop a bit more skill, develop more knowledge, experiment more, become more confident with your strategy, then I think it tends to shift a bit more maybe towards the psychological factors. But generally, you know, for most people early on, the skills, knowledge, and strategy are the challenge. Now, that's the general rule, so it's not always as easy as this, often when we're working with people. So this is where the evaluation phase of your trading is so important, you know, keeping very good trade records so you can have a look at, you know, for every trade you make, you know, the details of the trade, the thoughts and the reasoning behind why you got into the trade, the thoughts and reasons why you got out of the trade, what happened after you got out of the trade, you know, did the market carry on going or did it retrace back? So the better the quality of your evaluation is, the easier it will become to see what's happening in your trading, but also how much of the variance in your results is down to the strategy itself and how much of that actually is down to your interference with the strategy. But even for experienced traders, it can be difficult at times, you know, because obviously markets are dynamic, markets can change, and even experienced traders keeping good records, it's still not always easy, you know, to spot the exact reason behind why something's not working. But I say, you know, the record keeping, the evaluation makes that easier, and then sometimes obviously it's experience and a bit of judgment can help as well.
Okay, thank you. Another one. I think you mentioned that fear and excitement are those two elements that cause us stress. But how do you manage greed? Greed is also a common feeling that we traders experience.
Yeah, so for me, greed is just another form of fear. Greed is essentially fear of missing out. So when we experience greed in trading, often, you know, we're afraid of missing out on some kind of opportunity. So it's an activation in the nervous system, similar to, you know, a fear response or an excitement response. Now, when we do session 2, we'll look at mindset. So one of the key things that's important to recognize is how our perceptions, our beliefs about trading and about the markets are like a filtering system. And each of us has slightly different filters, like a funnel coming in of information. So we only will get or the strength of our fear response, or the strength of our greed, or the strength of our excitement is going to be in relation to how we're thinking about things at that time, to our mindset. So one of the things that's important to develop as a trader is a mindset, like, you know, like a filtering system, which then reduces your reactivity to these situations, but also, we'll cover this probably in session 3 when we look at emotions. When we are working with emotions, we also need to recognize that there are techniques that we can learn that again can reduce the reactivity and the strength of our responses, so that we can't just turn all these things off, but we can certainly manage them more effectively.
All right, thank you. I think this one, it comes back to this greed things, because you gave an example of a trader that you were coaching recently, and he lowered his trading size, and he started doing pretty well. Now, it does happen sometimes to all of us. What do you do then? Do you keep trading the same way with lower sizes, or you go back to your higher size trading? Because then you have in the back of your mind that if I will be trading higher amounts, I will be making much more money, doing so well and using the same strategy now that I'm back on track.
Yeah, no, it's a great question. So in our, I guess, this is where the excitement, this is where our nervous system kind of gets carried away, where that inner part of us gets a bit excited. You know, once we start trading well, for most of us, we get that automatic urge to start to want to trade bigger, and we make the assumption that if we are trading bigger, we'd make more money. If we imagine a letter U but upside down, so an upside down U, then what happens is, you know, if you think about the horizontal axis being risk or position sizing, and the vertical axis being performance or P&L, Where traders trade a position size that's too small, they don't get their best returns because they don't tend to pay attention enough, they get bored, they get complacent, and that affects their decision making. Where traders are the other side of that upside down U, then the size is too big, and that gets in the way of the decision making. They tend to take profits too early, they tend to become more loss averse, and that affects their performance. So for each trader, there's going to be an optimal, the top of that upside down U is really the optimal zone for position sizing. Now, it's not as easy as it sounds, because that upside down U is going to shift and change from trader to trader. It's going to shift and change for each trader based on the markets they're trading. It's also going to shift and change depending on the amount of volatility in the market, and it can also shift and change depending on what we call their context, their situation. So, like my trader in the example there who's been losing money, he's trading smaller now so the size he's trading now is optimal for now. Once he gets his kind of rhythm back and he kind of builds his confidence back, essentially that curve would shift a bit further to the right, so he'd be ready to take a bit more risk. The danger is, for all of us, and this is something we need to be aware of, is, are we taking more risk? For a lot of traders, I think the simple test is if you're finding it hard to follow your strategy, then one simple thing you can do straight away is reduce your risk and see if your trading behavior changes. And if you suddenly notice that you're now running your trades further on the upside and you're more disciplined on the downside, then you know that the risk was a factor. There are a number of other reasons, including the match of the trader to the trading strategy or the market conditions, that could be factors as well. But I have genuinely found in a very big number of cases that by adjusting traders' risk taking and risk profiles, by trading smaller, they actually make more. Slightly counterintuitive. It's a bit like being a racing driver. When you're driving fast in a racing car, you're not full on the gas all the time. You're trying to find the optimal speed through a corner. You don't want to be going too slow. You don't want to go too fast. There's a just right speed. If you go too fast, you crash. You go too slow, you lose time. And it's like that in trading. And I think once you see it in a performance mindset and you look at sizing as being something strategic, then what you're always looking to do, like a racing driver wants the optimal speed to get the fastest times, we want the optimal sizing to get the maximal returns. And if you start to see it like that, mindset-wise, then that can certainly be helpful.
All right, thank you. One of the last questions. All this sounds so serious. You have to be focused. You have to be prepared, not only tactically, but also psychologically. But in order to achieve, can you achieve high performance trading just by being a part-time trader, not a full professional trader like the ones you work with?
I think if we look at any performance area, let's look at, I don't know, it could be music, could be sport, could be poker, trading, any profession really. You can achieve success part-time. I think it's a lot. My honest own view is I think it's significantly harder. If I look at the professionals that I work with, they're trading 10 to 12 hours a day, 5 days a week. They find it difficult, and they've obviously, some of those guys have got access to good information. They've got fast systems. They've got quite a lot of edge over a retail trader. I have done a lot of work with guys trading from home over the last few years, and there are people who are who are very successful, who do make a very good living from trading from home. Most of those people maybe started off part-time, but obviously as I guess there was a tipping point where they realized maybe they could make it, and then they committed to doing it, more of a full-time profession. There are fewer people who I know of who are doing it, what I would call, literally part-time, a few hours a week. Now, I wouldn't want to say that it's impossible, but I definitely think there's a relationship between the amount of time that you can commit to your trading, the amount of practice that you can get, the amount of immersion you can get in the markets, the amount of training you have, the amount of coaching you get. I think all those factors significantly increase your chances of success. just as they would do if you were learning, you know, tennis, or if you were learning how to play the guitar. You know, the more time you spent practicing, the more support and coaching you got, you know, as a general rule, the better you're going to get compared to somebody with less of those resources. So, you know, if you want to make trading a success, it is unfortunate. You know, it is pretty serious. You know, it is. You know, you need to see it as a business. You know, it's basically it's a one-man business. Running any kind of business is pretty serious if you want to make money from it. If it's just for hobby, for fun, then that's different. But if you want to be successful, then I think, you know, it has to be serious. Doesn't mean it can't be fun just because it's serious. I don't think the two are mutually exclusive. But yeah, it doesn't require focus, takes time, takes effort, takes a lot of commitment, a lot of dedication. Because even the full-time pros find it difficult, and they've got, you know, a lot of edge. So it's yeah, I think that's probably my view.
Yeah, the funny thing, many of us treat it as a hobby, but we want to be successful at the same time, you know, and that's the problem. And the last one, so you can do some marketing for yourself, Steve. The question is your book High Performance Trading available as an audiobook?
It is. Oh no, I don't think it is. No, I think the other book, Trader Mind, is. I don't think High Performance Trading is. No, I think it's only available in written form.
Okay, thank you. Appreciate it. I think that's it. I don't see any more questions, so I want to thank you, Steve, for today's presentation. We appreciate it a lot, and we look forward for the following webinars. Want to thank everybody that participated. I hope you enjoyed it. I hope Steve made you think about yourselves and your trading, and I hope we meet next time. Thank you very much.
Thanks, Adam. Thanks, everybody.